Okay, so let's jump right into another installment of how's the market and what do I need to tell my clients. So, to give you guys a market snapshot of where we are as we sit right now in the middle of April 2026, let's go from Greenville up to a little bit more of a trend line statistic analysis, and then we can kind of take it from there. So, Greenville's not frozen, but it is a little bit more selective right now. The city's median listing price is about 389,000, which about a 7% year over year change, with homes that are sitting on or about 51 days on market. That is up about 37%. In Greenville County, however, the median sale price in March was up about 4.3% year over year to 365,000, a slight little difference between median sale price and median listing price. While that average days on market stretched up to 81 days, up from 62 a year ago. That really kind of tells me that prices are still holding, but buyers are taking a little bit longer and negotiating a little bit more carefully. Locally, there are also about 526, give or take, pendings in Greenville, which says demand is still moving. It's just not moving quite as frenetically as it was, let's say, a year and a half ago at this same exact time. Part of that is interest rates, part of that is just buyer sentiment, but still, overall, the bigger backdrop kind of shows us that pending home sales rose 1.8% month over month across the country, with the South up month over month and year over year ahead of the other regions in the country. Housing Wire, which is where a place that I gather a whole lot of my data from, Housing Wire shows that weekly pending sales year over year are supporting the idea that contract activity has a whole lot of life, but nationally, existing home sales still ran at just about 3.98 million last year, which is well below the 5.2 million transactions that is basically the long-term norm. So we're not in a full throttle rebound, but I'm going to show you a graph in a second that's actually going to show you that the momentum is swinging clearly in our direction. Greenville still has price resilience and active buyers, but the market has kind of shifted closer to a little bit more of a normal, if we even want to use that word. The pandemic doesn't really count, and we're not going to hold ourselves to that standard of the pandemic because homes are going to take longer. Inventory is still very tight, even though it's loosening up just a touch. So despite the fact that you may read some things in some national news articles and some national data may give you an indication that things are still very stagnant, in the Greenville market, momentum is improving modestly. It's just not exploding the way that some of us have experienced in years past. So with that, you'll also see that mortgage rates are now currently at their lowest level in 3.5 years. You can look at that right there, all the way back to September of 2022. Of note, Federal Reserve Chairman will be changing in the next month and a half. So look for some volatility. Maybe not, but don't be surprised if it comes. The change in Fed chair, the change in Fed rates, those things and their relative connection to the 10-year treasury and the 30-year mortgage, which if you'll look at this next slide, the 30-year mortgage versus the 10-year treasury yield, you'll look here, that orange line that goes across the screen that has steadily trended down from 23 to 24. We kept going. We cannot have this big of a spread for this long. It has slowly but surely, from red to blue to orange, gone down. Now that spread is slowly creeping back up again. Do I think that we are going to experience a higher spread between the 30-year mortgage and the 10-year treasury? Not necessarily, but also I would say don't be surprised. If the next Fed chair comes in and lowers rates, do not expect mortgage rates to instantly drop, because in fact, when mortgage rates spike after a treasury yield number that goes down, or the general rate, the Fed funds rate, when the Fed funds rate drops, it doesn't necessarily mean that interest rates for 30-year mortgages are going to immediately drop. In fact, sometimes the inverse happens. So I'm not saying that just watch for those folks that you have in your ecosystem that are saying, I'm waiting for rates to drop, rates. As soon as the rates drop, then everything is just going to fix itself. Just bear with us and go, well, maybe. But just understand that not only is the mortgage rate as low as it's been since 2022, the spread is as low as it's been since 2022. And that is a good thing for housing and for housing stability, because that spread is so low, it is almost coming back to where it has been traditionally, which is almost directly tied to the Fed funds rate. So let's look at those trend lines. I said that we were talking about just kind of a modest improvement. Let's go over here to the right-hand side of this graph. Let's watch these trend lines. Note this huge pivot from pending sales and average days on market from January all the way up to now. Look at December and that massive, massive gap between average days on market in the blue, pending home sales in the orange, and the median list price in red. And watch as we went into the first part of this year, the first quarter of this year. Yes, there has been kind of a downtick in median list price, but that was a byproduct of the market. That's list price, not sold price, mind you. That's the market overcorrecting and then recorrecting. So I want to watch that trend line as we keep moving forward, because yes, this is the spring. This is the spring selling season. This is the prime time for everybody. I believe that the market has been a lot better as of late at being proactively reactive, if that's an option for us to even say. But I want us to keep in line with the understanding that if I am a listing agent and I am having a conversation with a seller, we have to understand that my list price as soon as I go out the door is directly correlated to how much interest I will get in the home and ultimately the sold price. We need to be, now more than ever, because there are more pending home sales. The average days on market is ticking down ever so slightly, but also we noticed that the average, or median rather, list price has followed itself down to where the demand is, because we know that there is no manufacturer suggested retail price of real estate. There is only what a buyer is willing to buy and a seller is willing to accept. So when was the last time really that we felt like we had a fairly balanced real estate market? Well, I mean, if you look at this, you would say the last time that we had a decently balanced real estate market was all the way back in 2017. And we have almost gotten directly back to where we were at the beginning of 2017. Do I say that that's a balanced real estate market? No, because our life and times are completely different than they were in 2017. That to be said, our inventory is moving in a positive direction, and a positive direction doesn't necessarily mean that we have too many homes for sale. We are now, as a market, finally catching up to that bottleneck that was created in 2021 into the rest of 2022. Is that a balanced market? I feel like 2017 was rocking and rolling. Now here we are in 2026 with the exact same month's worth of supply in inventory, and we feel like it's slow. Let's take a little perspective in that. Now, because the market and that modest warming signal, mixed signals, mixed emotions all over the place, with a median list price that's rising, and I think it's worth saying that the median rent also in the Greenville Association of Realtors data says that it has ticked up to $2,225 a month, which, as a side note, that's the payment on a $400,000 house with 3% down. Median days on market are also down. Rent is up. Price gains are slightly up. Rent is up. Median days on market being down. The price gains indicate a slightly stronger buyer activity and a little bit of a quicker turnover, but still supply and seller behavior are sending kind of conflicting signals, which inventory increased about 1.5 points, suggesting that there's a little bit more stock and fewer stale resale listings. But the share of listings that are taking price cuts edged up, implying, back to the other graph, we'll go back here, all of that median list prices up and then back down to earth. It's showing that that price cut means that a meaningful portion of sellers are still trimming the price to come back down to earth and ultimately to get deals done. So short term, that trajectory for me, especially in the Greenville area, is mildly bullish, with prices and velocity inching up ever so slightly. But the simultaneous rise in inventory and the slight increase in price reductions are really early signs of kind of some friction going into the summer months. So there's a little bit of an impasse right now with buyers and sellers. If that drop in days on market and price gains continue, then seller leverage is going to increase going into the summer months. But if inventory growth and the rate of price cuts accelerate, then we're going back a little bit more towards the buyer's side of the equation. And let me give you just a slight little detour into the national viewpoint. Let's look at household debt and delinquency. So the total household debt in Q3 at the end of 2025, they haven't come out with all this stuff. This is government data. I know it's not totally up to date, but that quarterly update in household delinquencies and debt has increased 1%. The mortgage delinquency rate, which if you look at it right now from a right now on the nose perspective, it's about 3.79%. So it's a little bit lower than that. So your mortgage delinquency rate, while total household debt is increasing, the mortgage delinquency rate is still incredibly low. So that foreclosure, that REO sale market is not in any way, shape, or form a significant portion of our economy. Mortgage originations continue to grow. Last year we had $1.88 trillion in mortgage originations, and in 2026 that forecast is supposed to almost time and a half. So a $5.8 million loan forecast increase per capita, which is a very funny statistic to try to peel back. If you have any questions about that, please just let me know. Just understand that our loan origination model from National Association of Realtors data is showing that there's going to be another 7.5% to 8% increase in mortgage originations this year. In existing home sales, 2025, we are literally crawling out of the cellar right now. 4.7 million. It was well below the estimated was about 5.6, and now the more modest estimate for 2026 says 5.16 million in terms of existing home sales. That's home sales across the entire country. 5.6 million home sales out of a population of just slightly south of 400 million people. That's incredible how low that is. And inventory, while up 14%, is still well below the benchmark from Housing and Urban Development, which should be about 2.2 to 2.25 million units in inventory nationwide. We're still only at 1.55, even though we grew slightly versus September of 2024. And finally, that new home market. And, you know that we have a very vested interest in trying to put new inventory on the ground to help people have an option to buy new versus resale market. That builder confidence index is not great. That HMI of 38 is roughly 10 basis points below kind of what you would say would be modest buyer or builder confidence rather. Builders reducing prices. This was just as of November of last year. 41% of builders are actually reducing their prices. Now, this is nationwide. This is not here in town. And if you need any additional information, you can contact me. You can contact Stephen Dial with our new homes division. You can just ask the questions, and you can communicate also with the on-site builder rep too. But the average price reduction as of November of last year, now granted, we were kind of falling off a cliff in November of last year in terms of demand. So these numbers could be slightly skewed. Take this with a grain of salt. But the average price reduction in November 2025 was 6%, and now that is nationwide. Now, what do we do with all this? I got 3 keys and a suggestion for you. It's just been tax time, and a lot of our sphere and our clientele are looking for a helping hand with what to do right now from a financial perspective. And so spring cleaning can mean a whole lot of things. Maybe it's time to talk to our previous clients or potential future clients about the tax implications or the things that they can actually do to protect their investment or investments. Maybe it's just the right time to use that refund for some deferred maintenance around the house. Well, but it's definitely the right time to conduct as many real estate reviews as possible. And I'll stop right there for any of you that are not familiar with what a real estate review is and you're not in the ninja universe. A real estate review is essentially a CMA, but it's a little bit more of a beefed up CMA. If you want some information about how to do that, call me. You always know that I'm accessible. The end goal for those real estate reviews is to promote having more in-depth conversations with your people about their real estate goals. And finally, on us, it's time to clean out the cobwebs in our database and make meaningful touches that will result in transactions in the second half of the year. All of that to say, this is the time for us to start sweeping up our own affairs to help clean and prep the table, so to speak, for the business that we will do in the latter half of the year. Now is the time to set the table for the latter half of the year. And we do that by equipping ourselves with the right information and to be able to deliver it confidently and communicate it effectively so that we can actually have good conversations that can lead to conversion that eventually leads to a compensation at the end of the day. Because at the end of the day, most agents know what's happening, good agents understand what's happening, and only great agents can explain what's happening. I hope you guys have a great rest of this April. I will see you again on a recap following our next Synergy meeting. Do good, learn lots, have fun.